Welcome. People are joining in and coming off of the waiting room. I'm letting everyone in. Thank you so much for everyone for being here today. We're in day 3 of DC Startup Week, closing this with the last panel of the day. I'm so excited to be here from WeWork in downtown DC. My name is Rachel Koretsky. I am one of the organizers of DC Startup Week and a founder of a tech startup, UPace. I'm so grateful that this week is possible. We have 4,000 attendees across 5 days, 100 events, 200 speakers, and really the only way that's possible is through our really amazing sponsors to make it happen. So I want to say a quick thank you to our title sponsors this year, Next, powered by Shulman, Rodgers, Insperity, Technology Rivers, and Wiz. We have Anthony Millin here today moderating the panel as the chair of Next, and we also have Lisa Friedlander on the call, the woman behind the scenes who kind of made the title sponsors possible with us. So huge thank you to you. So I'm really excited for this panel today, talking about venture capital and how you're able to get to VC funding. I think this panel is really special, not only having Anthony, who helps founders go through all the stages of fundraising, but also having 2 founders who successfully fund it all through going from angels to pre-seed to going to then venture capital. Shai, one of the co-founders of Hungry, as well as Kirsten, the founder and CEO of Jeenie, and also to mention, Jeenie allowed us to have possible ASL interpreters throughout the week, making sure that DC Startup Week is inclusive and accessible to all. So a huge thank you to you. And then we also have Bob. He is one of the venture partners at Pier 70 Ventures. I got to know Bob through Diego, one of the founders of Together International. So thank you so much, Bob, for being here as well. We have one more panelist who's going to be joining in that I'll add him to the screen, making sure that he is all set to go. So you're going to be seeing that. His name is John. He's one of the managing partners at Motley Ventures. So with that, please join me in welcoming Anthony, Shai, Kirsten, Bob, and John to the DC Startup Week stage.
Great. Thank you so much, Rachel. And thanks everybody for joining us tonight. We have an incredible panel with us today as we tackle the topic of the journey to VC funding. What I'd like to do before we actually get into the substance of our panel discussion is to just go around and just have each of the panelists just introduce themselves and their company. I'll give a brief introduction after that of myself, and then we'll jump into our discussion. So Shai, can we start with you?
Yes, thank you for having me, Anthony. Pleasure to be on this panel with our other esteemed guests. Real quickly, Hungry is a revolutionary technology connecting independent chefs with a $60 billion business and events catering market. Hungry's gained investments from several high-profile investors. We have the rapper Jay-Z, the actor-comedian Kevin Hart, who's invested, the singer Usher, a number of NFL stars like Todd Gurley and Bobby Wagner and Dominican Sue, and some top chefs like Tom Colicchio, and the founders of Whole Foods and Honesty. So grateful to be here in the DC area. We're also a mission-oriented company. We're committed to improving the communities we serve through our Fight Against Hunger program. For every meal that's donated, we donate one to the needy. We've donated over 500,000 meals so far and hoping to do a lot more. We're located in Arlington. We've expanded operations in Philly, Atlanta, Boston, New York, Austin, and Dallas. We're just a couple years old and super excited to share more.
Great, thank you, Shai. Kirsten?
Thank you, Anthony, and thank you so much, Rachel, and DC Startup Week. And I just want to say I'm going to speak a little slowly on behalf of our ASL interpreter, Renee, who's doing this session because it makes her life a little easier, but very happy to be here. Honored to be on this panel with everyone. Jeenie, I'm the CEO and co-founder of Jeenie, and Jeenie is a mobile platform that connects you to an audio or video call with a live interpreter for on-demand language assistance wherever you are in the world. So essentially, we're the only gig economy language service provider. So think, Uber for interpreters. We've gone through a number of different use cases and industries in our time. We're currently serving the healthcare market very heavily, especially because of the increased need during COVID for access to language, which is also sort of, equivalent to access to healthcare. And we're supporting a lot of our healthcare clients in their efforts for diversity and inclusion and serving underserved markets. We are an early stage company, so we're a younger company than Shy's company earlier. And we've had the privileged pleasure of working with investors from friends and family all the way up through venture capital, and having people put in, $10,000 all the way up into millions of dollars, including, sort of billionaire, high wealth individual investors. So we've had a lot of different kinds of experiences with investors that we hope to bring to bear today, and we hope that it will be helpful.
Great. Thank you so much, Kirsten. Next, John.
Hi, and sorry for being late. I'm John Keeling from Motley Ventures. I'm a venture partner with the Motley Venture Fund. We are a Series A focused venture fund. We've been investing now for almost 2 years exactly. And Shy in Hungary are one of our portfolio companies, so we're very excited about them. And then I split my time between the venture fund and serving as a venture partner, or excuse me, serving as the business development lead for the operating company at the Motley Pool.
Great. Thank you, John. And Bob?
Yeah, thanks, Anthony. My background is as an early or a fund of funds investors with the Boeing Company, investing in advanced technology, and I'm now the co-founder of Pier 70 Ventures, which is a direct investment fund in early and growth stage technology companies around aerospace and aerospace technologies with interesting applications in alternative markets. We intend to invest mostly in aerospace technologies, and we have this intentional focus on investing in companies led by exceptional and diverse leadership teams, including women and people of color and people of all abilities. And I'm happy that Rachel invited me here today and look forward to our.
Great. Thank you, Bob. And just briefly, my background, I've been a serial entrepreneur and a venture partner at Urbanus, a seed stage VC fund in the urban tech space. And I chair Next, powered by Shulman Rodgers, which is a DC area law firm with a regional and national practice. Next is an innovative new model for delivering legal services for the full service and full life cycle of startup and emerging growth companies. We offer predictable legal fees through more than 75 fixed price packages and service bundles specifically designed for startups, which are delivered directly by Next senior attorneys through a very high-touch, hands-on legal service model. And we also integrate technology from leading platforms like NASDAQ and Carta and UShare and other best-of-breed tools to create a collaborative, transparent, and efficient client-centric experience. So we really have a group of panelists that cover kind of the range of perspectives as we enter into our subject matter tonight. So the first area that I'd like to just talk about to set the stage is just to give a sense of the DC area venture market. So what are you currently seeing in the DC area, both breaking it out into the seed stage market, seed venture funds, and kind of what's driving those trends, and then what you're seeing in the little bit more upstream Series A financing market and impacts that you've seen with COVID and other changes in the marketplace. But be very helpful just to kind of get a perspective of what you're all seeing in the market. And so maybe this time we'll start with John.
Sure. I think we've seen a pretty predictable transition from a hesitancy to invest at all. I know back at the very beginning of the crisis, a lot of venture funds were checking in with one another to see whether or not they were actively investing. In a lot of cases, the answer was no. If you're a fund like ours that operates on a capital call structure with regular capital calls, which are funding our new investments, we knew that our LPs were in a situation where they were capital constrained, they had liquidity problems, and that we would likely need warehouse financing in order to continue to invest. We actually did invest through that period, but a lot of folks sort of started to hold back. I think that has changed in the Series A market now. I think there's a lot more activity, but there's downward pressure on valuations. So I think as a Series A company with demonstrating some product market fit, some revenue traction, there's plenty of capital available, but valuations are lower. Multiples are lower than they were pre-crisis. Seed, I think, is still challenged. I think people are still risk averse. We don't know what the new post-COVID world is going to be like, and I think there's still a lot of hesitancy to take the risk of companies that may be pre-product or pre-revenue.
Great, thanks, John. Bob, if you could kind of add a little bit from what you're seeing.
Yeah, so I don't have a good focus on what's going on in DC, but more broadly, nationally, we have offices in Seattle and San Francisco and here in New York, and not much difference than what John already went over. I mean, there's definitely some hesitancy, but there's some really great opportunities out there that people need to move quickly on. So if you have technologies or business models that in aerospace, if you can help the airlines get people flying again, the return to flight initiatives is huge. And we can see that there's a lot of other companies that are doing really, really well in this market, and people are moving on those issues. But I think there's a lot of hesitancy otherwise.
And then I think it would be great to just also get the entrepreneur perspective. So from Kirsten and Shai, just to hear a little bit about what you're experiencing yourselves, and just as you're out speaking with other fellow founders in the region, kind of what you're hearing would be great to just be able to share with our audience tonight. So maybe Kirsten, if you could start, that'd be great.
Sure, absolutely. Thanks, Anthony. We've sort of seen the other side of what was just articulated from our funders, which is there was a complete quiet, I think, when COVID first came about in Washington, D.C. And, pretty much everyone just sort of went into kind of wait and see. It was very interesting times for us because this was actually going to be at the end of this year, our Series A. So we had to kind of look at the market and really reevaluate how to approach it. The approach we took was to do yet another bridge round, which kind of feeds into a trend that we have been seeing in the Washington, D.C. area of kind of more younger seed stage companies doing more bridge rounds before they get to the Series A and having a lot more traction under their belt before they get there. And so we raised kind of another smaller round in order to kind of get through what has been sort of this kind of COVID, crisis. And we definitely saw, even in bringing in this round of capital, we were fortunate enough to do that in July, but we had to kind of relook at valuations as everybody else was. Everyone sort of called it the COVID tax. And, we definitely adjusted caps on our notes and things of that nature. But to our delight, we're actually seeing a lot more of that sort of, kind of now the interest is percolating up again. And we're seeing that people who have kind of been waiting and a little bit more sitting on their wallets for a while are now looking for opportunities to invest in companies who are in some of the target markets that are doing well right now, such as healthcare, education, ed tech, and things of that nature. Also that, they're looking for not just chaos proof, but even chaos friendly businesses. So those that kind of do well, in sort of crises and have models that, will survive, if not excel in crises. So it's been interesting times for us, and we're very happy to see much more interest now kind of coming back to the scene.
Great, thank you.
On the Hungary side, I think we've seen a trend towards, pre-COVID, and probably will continue, is, bigger seed rounds. For us, we had a $4 million seed round, it's the biggest I've heard. And I think what drove it was that, we're blessed that we're here in DC, and there's a lot of high net worth individuals. There's a lot of angel investors in the DC area, and it's a lot easier for an entrepreneur who is just getting started to attract angel money. So You know, we're also probably seeing another trend towards maybe some food companies that are sprouting out of this area. Maybe that's attracting some venture capital names. You know, we've seen examples like Sweet Green. They came out of Georgetown. Kava came from Rockville, Maryland. Honest Tea came from Bethesda. And now hopefully Hungry here in Arlington makes a name for itself. You know, once you learn the pathway to the venture capital world and develop those relationships, you know, the VC world is accessible. For Hungry, it came to us through our relationship with Cooley. Cooley was a great law firm, gets startups going, and they've got access to all the investors. So they were very, very helpful. And then I was wise enough to partner, my CEO, he's raised $100 million in his lifetime. So I was able to attract a CEO that had a network that we could leverage to get to the VC world. And Motley Fool helped lead our A round. So we're very grateful for them. They were very accessible. You know, we couldn't have asked for a better investor.
Great, thanks. So that's very helpful just to kind of give the pulse of what's happening. So for companies that are getting ready to go out and raise funding, the first thing I'd like to kind of have our panelists share with our audience tonight is what are the kinds of milestones that you should have under your belt as you kind of move into the Series A, and kind of how does that differ from a company that's more still in a seed stage doing either their first seed round or additional seed round? So if you could just kind of talk through a little bit so that kind of help companies get a sense, looking at themselves and the milestones they've accomplished, where they should be looking and the kinds of investors that stage-wise they should be looking for. And so I'd like to kind of turn to that topic now, and maybe we'll go back and kind of hear it from John and Bob, and then we'll bring in the Shy and Kirsten again for the entrepreneur perspective on things that they look at to get milestone-wise to be ready at the seed and the Series A stage.
So from a Series A perspective, I think we want to see demonstrable customer traction. And you know, you can measure that in various ways. If you're a B2B business, we want to see enterprise customers, not just pilot customers. Pilot customers we would put at more of a seed stage, and maybe that would be a goal for a seed stage financing, would be to get a pilot customer to an enterprise customer, to be that kind of first referenceable enterprise customer. We're looking for revenue traction. So obviously we're talking about paying customers, and an understanding of your sales funnel. Again, whether that's B2B or B2C, that's really important, that you have your arms around what your customer acquisition costs, how you can scale them. You know, if you don't understand that, then you might be in a situation where you get investor money and suddenly you find that customer acquisition cost that you were able to achieve at, you know, much lower spend doesn't scale to a higher spend. And so that's frustrating for you and for your investors. So the more, you know, you've really gotten your arms around your funnel, even if we know it's not going to be where you want it to be, and you're going to want to lower your customer acquisition costs, and the things that you've got to improve in terms of conversion and so forth. But just, you know, having that discipline internally to kind of understand where you are, what you need to work on is really key. And then, you know, you have to be at a point where you're organized. That seems simple, but you know, you need to have a data room where you've been able to put your contracts together so people could review your customer contracts. You have financial statements. You have a financial model. Things of that sort.
Great, thanks very much, John.
Yeah. Thanks, John. John's always tough to follow. He's got all the bases covered. I looked at these questions, Anthony, before, and I wrote down, you know, scale, customer, and the one thing that John didn't mention that I thought I might, because I think it's really important, no matter what stage you're at, seed or earlier at Series A growth stage, whatever it is, you're trying to scale. I mean, venture capital investors are investing in companies at scale. We're not investing in, small, lifestyle businesses. We need to see some scalability, and those milestones are going to be a little bit differently, or those expectations are going to be a little different, depending on where you are. You had some questions here, Anthony, about technology and product development milestones. Certainly in Series A, we're hoping you have some technology and your product is developed. You have something to sell. You have some IP protection. Earlier stage, we'd like to see you have some R&D investment there, something that has sort of defined your product, and you have more than just a prototype or an idea. Would be good. The one thing that I wanted to comment on, though, is ESG. So this ESG factors are becoming more and more important for us raising capital in the market today with institutional investors, and they're looking for us to take note and understand what this focus on these environmental sustainability and governance issues are, and how they are rolled up in our strategy. And they're asking us to look down into our investment portfolio and what our companies are doing as far as ESG factors. So, John mentioned having a data room and getting organized and having all your financials organized and your contracts, but you might want to also think about ESG factors, what your company's doing as far as ESG. And then the last comment I'll make along the line of ESG, Anthony, is around team milestones. Don't forget diversity and inclusion in there. It's a really hot topic right now, and institutional investors are, again, looking up to us funds to have diversity and inclusion as part of our strategy, and we're looking for our teams that we're investing in to include that.
Yeah, I'll amplify that point. I think, again, it's part of the moment we're in. I think every venture fund I talk to is talking about diversity and inclusion, and it's a more important filter than it's ever been. Now, candidly, for some people, it's probably more talk than action, but I think for a fair number of funds, and I hope we're one of them, there's a real commitment now to invest in underrepresented entrepreneurs.
That's great. Shy, in terms of when you've gone through multiple rounds, kind of how did you kind of look at what you would get under your belt before you kind of moved up to those rounds?
Yeah, I think everything that John and Bob mentioned was dead on, and you have to be a fundable startup. There are a number of items you need to have going for you before the funding will come. As a young entrepreneur, you believe you need that money quickly to make anything happen. Although that funding is necessary early on, it has to be satisfied by pulling it out of your own savings before you hit those milestones, pulling some money from friends and family until you can become that fundable startup. And some of those items include, as Bob shared, you have to have an amazing product that's moved from prototype stage to something defensible and working. You need to spend at least a year building and polishing that product. So that's something that your customers will actually use. It's not just some idea in the entrepreneur's head, that it's something that's gone through iterations and feedback and use. And then a management team, a CEO that investors can trust, that has experience and has done it before. With Hungry, we had the same management team that had done it before at our prior startup, LiveSafe. So investors felt that de-risked their investment to give us a shot. So credibility is everything, and everything you can do to build that credibility goes a long way. FOMO, leverage a couple big names, major milestones, create excitement. If it looks like you've been raising this round for a while and it hasn't filled up, there's not much excitement around it. But if you have a date, that's in a couple weeks or a month, and you're 90% there, 80% there, that's exciting. Everyone's going to want to pile in. And you become oversubscribed. But how do you create that FOMO? It's really important. As John said, real traction, sales. You have to have actual sales and revenue coming in before an investor is going to give you money to pour fuel on the fire. And then last thing, probably your deck has to look like $1 million. Our seed round deck look like $1 million. Our A round deck look like $1 million. Our B round deck look like $1 million. You have to build that credibility and trust. And sometimes a book is judged by its cover. Once you have your content perfected and financials perfected, it's worth handing to a rock star designer and make sure that deck looks like, telling a great story.
If I could add a little bit to that, because it brings to my mind some sort of qualitative issues that I might bring up. It's not just a sales process when you're out raising money. I think a lot of entrepreneurs think, they're selling. And obviously to a certain extent you are, but I always like, particularly that first meeting with an entrepreneur, if I feel like they're really embracing their role as a teacher. Depending on the particular business, I may know more or less about it, but no matter what, I want to come out of that meeting feeling like I've gained some unique insights about the market and the market opportunity, as well as that company's kind of competitive positioning and differentiation. And I think that's really important. And I think the distinction between maybe selling and teaching is kind of on that continuum between passion. We want to see passion. This is a 10-year relationship we're entering into, and we think about that. We want to enter a relationship with passionate people, but we're also looking for people who aren't arrogant and too cocky, because we know you haven't figured it out. We haven't figured it out, and there's going to be a lot of learning along the way. You look at somebody who maybe is viewed a lot as cocky, someone like Elon Musk, but he has a product philosophy that he lives where he says, assume you're wrong, and your goal is to be less wrong. And I really like to see that from the entrepreneurs coming in, telling everything that's wonderful, but assuming they're wrong. And our goal in our relationship working together is to make things less wrong over time. So.
Great. Kirsten, if you could, one of the things you spoke about, which I think is really would be helpful to share a little bit more, is, like you said, a number of people are going through multiple rounds during the stage as they prepare for the A round. So it would be, how do you kind of approach that? How did you think about how much additional runway to give, if you're adding additional rounds, how much additional runway do you look for? And maybe talk a little bit, just following up on what John said, in terms of that first meeting is so critical, how you kind of would advise people about that first meeting that they have with an investor from your, many times doing this.
Well, I think for us, one of the big differences in knowing whether or not, we're sort of seed stage still versus ready for Series A had a lot to do with, product market fit. And so really kind of understanding where we were on the spectrum of our product market fit. And, Shai did a great job of sort of describing, if you've got an MVP and you're just out there sort of testing your technology and getting your feet wet and just trying to see if any of your hypotheses are the same, things that customers love about you, or, which are the same things that you think are great about your product, those actually have to match. And if you're still in that process, you're in a seed stage. And so the way we thought about kind of seed into Series A was, are we still in search of a product market fit? Have we found a product market fit, and we're, really trying to kind of prove it out? And last fall, we went through what at the time felt like a painful exercise of, we don't just want to be kind of focused on event-based models and disposable income markets, or markets that were, kind of very dependent on disposable income. So we went through a whole product market fit at a time where we really thought we should be selling. But we forced ourselves into the discipline of really kind of going through this full exercise, and we came out of it at a very similar time where healthcare kind of came looking for us, and we had sort of been moving in that direction. And so for us, we ended up with this product market fit that really felt good. And now we could kind of enter at the beginning of this year into this phase of let's explore it, let's test it, and let's see if it's right. And what we've seen in that is the acceleration of those enterprise clients in healthcare now coming on board. And so now we have a product market fit that is being proven in the marketplace. I think, as John was saying before, we have paying enterprise customers. And the other thing we were looking for is significant month-over-month growth in order to kind of see that. So it's not just kind of a blip or, you know, we just run an article in Fast Company, and so we got a lot of attention, and then it sort of faded away, but it's been consistent now. And that growth is continuing to grow. And for us, one of the benchmarks we looked at, which we think is really important if you're thinking about Series A, is really thinking about how are you going to get to that 100,000 K, you know, that 100,000 MRR, monthly recurring revenue mark. Because having your, you know, that 1 million, 1.2 million, you know, annual recurring revenue point is a real kind of indication that if you've got that, in addition to the growth of customers, new enterprise customers, the growth of whatever usage means for you, you're really kind of ripe, I think, then for Series A. So that was sort of why, or Anthony, how we thought about staying in stage seed a little bit longer before moving to Series A. And then to answer your question about, you know, the first meeting, I don't know if John and Bob would agree with this, but in my opinion, the first meeting should never really be when you need money. Ideally, you know, you're kind of meeting people along the way. You're letting them know what you're doing. You're trying to get them excited. And if you do a really good job, you kind of, you know, set expectations then, so that every time you go back and talk to them, you've done so much better than you actually told them you would do. And you kind of work up this system of staying in touch, keeping them on a mailing list, you know, for updates, whether it's just for investors or whether it's your, you know, kind of total mailing list. And that's how you sort of stay in front of them. And then when it's time to have that conversation, it's not really a first conversation, and you've consistently underpromised and over-delivered along the way.
Great. So, you know, John and Bob, just from your side of the table, how would you recommend, along the lines of what Kirsten said, you know, people reaching out to you just to get on their radar screen? I think a lot of people are hesitant to do that. You know, how would they even go about that? What are some ways that they can think about that? Bob?
Yeah, thanks, Anthony. I think Kirsten made a great point. I mean, for me as an investor, I'm reaching out to institutional investors and you know, making contact and letting them get to know me and what they do. And I'm looking for investors that are interested in what I'm doing as a fund. Same thing is true for your portfolio company or for you guys as entrepreneurs. You want to reach out to us and make yourself known, and so we can sort of see what you're doing, and under promise and over deliver is a great strategy, Kirsten. So I think that's really important. Finding the right VC, though, is also important. We talked about this on our call earlier last week, I guess. You know, make sure that you're reaching out to people that can help you besides just give you money. You know, we have a focus in aerospace and advanced technology and a variety of applications. We talk about that on our website. You can go to different websites. You can talk to other entrepreneurs where they're getting money, particularly if you're looking locally in the DC region. Find out what they're interested in investing in, what their strategy is, and their background. Because if you're going to take some money, you want to make sure that the money comes with some other skills and resources. So, you know, if you have an aerospace technology, like someone reached out to me earlier on the chat, you know, how good is it if your investor can give you some money, but they also can open doors to, you know, some of the engine manufacturers that you're looking to meet, and Pratt and GE and Rolls and all those. We have all those contacts. Those are the kind of people you want to talk to. So what depends on what your product is and what your market is. You want to talk to people that are in your space, in your stage of investment, and in your space.
And, you know, one of the other things that we've touched on a little bit now is, you know, you have the milestones in place and you're ready to go out for funding. We've touched a little bit today on what you need to do to get ready for that process. You know, Shai, you spoke a little bit about really having a strong deck and maybe even having somebody work on it just to, I think you said, make it look like $1 million to really have a strong deck. And we've talked a little bit about financial models. You know, maybe John, receiving as entrepreneurs are thinking through and gearing up for that process, maybe you could just share some insights of what what it's like from your side when you're getting hundreds and hundreds of investor decks in the course of a year, or thousands, and the importance of investing the time to prepare the material that's being sent over to you.
Well, it somewhat goes back to Kirsten's comments in the sense that to the extent we have a pre-existing relationship, and we've been able to track your progress and see that you identify milestones and you're consistently able to hit those milestones. I mean, that goes a long way from when you're actually raising money. And what's behind all that, I think, is, as you mentioned, we see hundreds or thousands of opportunities. And the more thoughtful the entrepreneur has been in terms of trying to be aligned with us in terms of the type of fund we are, the stage we invest in, their goals for the financing, and how they think we could add value, that goes a long way. So again, this is a 10-year relationship. So the sooner we can get into that conversation, are we aligned at where you are in terms of your stage, in terms of what your goals are for this financing, and how we can help. And those are three things that can be a part of the deck in some cases, certainly in a part of the initial conversation for sure. And so, I agree with everything Shai said. You want it to be professional, you don't want it to look amateurish and unbelievable. But, I think that alignment is what I would want to emphasize, and put thought into it. I mean, don't go, solicit every single VC that you find in a Google search, that we want to see that you've sort of filtered through who you think is the right investor for you, and vice versa.
How important is geography? I know we talked about the importance of finding investors who have the right stage and the right market segment. How have you, both Shai, from, you've spoken about investors that were strong initial investors in the area, John, and how important is kind of the geography to looking for an investment at this stage? And, how important is it for the entrepreneurs to be trying to align that way?
I'll jump in. We're willing to go anywhere. So we're concentrated in the Mid-Atlantic, as you might imagine. That's just, where our network is, and where we get the most deal flow. But we've invested throughout the country and outside of the country. So, it kind of relates to another issue that's come about through COVID, where for the first time, we've made investments where we haven't met face-to-face with the entrepreneurs. We haven't visited them on site, which is something we prefer to do. You learn a lot about a company when you walk in their doors, and you can really sort of sense their culture better than talking to founders or the management team. But, it's not essential. We feel good about the process we've gone through with companies where we're not meeting face to face. So I think that, makes us feel more comfortable investing outside of our geography. Now, I'll be honest, there is always that sense when something comes across your desk that comes from outside of the region. Is there an adverse selection phenomenon here? Why is it coming across my desk? Why hasn't it been invested? So I would say that when we invest outside the region, it tends to have come through a trusted source, as opposed to us just, being solicited by a company outside of our region or finding them through our own research efforts. So we need some sort of validation of the opportunity if it's outside of our region.
I was just going to add, as a DC entrepreneur, it's probably your first bet is the VCs in the area, but we're not far from New York City. So there's a lot of money in New York City that is accessible to DC entrepreneurs, our first angels, and some of our early billionaires and Live Safe. They're all in New York City. I think we always want to try to access some of that West Coast money that sometimes goes at higher valuations. but sometimes they prefer to have those companies be there in the West Coast. I think that's changing a little bit, but as John shared, there is a little bit of that building of relationship that does happen in person as well. How easily can you get over there for a meeting or a board meeting or, a pitch, or similar to what Kirsten shared, it's like dating. You have to build a relationship. Not many give money upon first hearing the idea or first meeting. So it takes a lot of communication, a lot of building credibility and transparency to get it to that point. So wish we were on the West Coast and we had more access to VCs, but we don't. That's again why I think the angel rounds are bigger here in the area, but I think the VC market's getting more exciting with Motley Fool doing a lot of investments now, and Revolution's been doing a lot of great things, and Bob's firm is a good one. We've also been had the ability to attract some celebrity investors. And I think if we were on the West Coast or New York, that might have been a little bit easier, but it meant a lot of flights out to LA and where some of these big names were. So I think geography does matter.
One of the things that's come up a few times today is this concept of it's a 10-year relationship and it's a long-term partnership. And we've spent time talking about diligence from the perspective of a VC looking at a company. I'd like to turn the table a little bit now and talk about, from the entrepreneur's perspective, if and how you go about looking at it in the other direction, which is equally important to this long-term relationship in terms of diligence and understanding if this is the right investor for you, and your experiences with that, and how you would tell fellow entrepreneurs on the call today about that side of it.
I'll kind of dive in there, Anthony. And, I thought John's point about kind of the 10-year relationship, if you're lucky, I think in a lot of cases, it can go a lot longer. Maybe you're luckier if it goes longer, I don't know. But you really think about, what your parents might have told you about kind of that relationship. Be sure you sort of know the good and the bad, see somebody really early in the morning and know what they're like when things are going well and when things are going poorly. When a market's going well, how do they behave? When a market's going poorly, how do they behave? How do they kind of think about your future? Because this is a really long-term relationship, and you should think about it that way, no matter what the ambitions are for kind of exits. And we're all realistic about that because we're all sort of in this for certain goals and shared goals. And I think for us, just back to your geography point, there's definitely something in geography to proximity, because being able to go sit down with Bob or go sit down with John on a regular basis and kind of talk about what's going on in the company, we definitely get a better sense for one another's culture, who we are, what our, real sort of, innards are built on, versus being on Zoom all the time. There's no question. But, Shai also made the point that if you're a DC entrepreneur, you're kind of more limited in terms of the number of VCs and funders that you can get access to. So you also have to be a little bit, kind of realistic about that. The stereotypes of funders in certain geographies are kind of real. Bay Area funders, VCs are known for, it's often kind of been what their focus is. There's a reason, you go out there for big consumer marketplaces versus, New York, where it may be more kind of, SaaS oriented enterprise models, and you better make, the revenue needs to be there. And I think that for us, what becomes just as important as that kind of personal connection, if you can have it, is if you're not even proximate, is really understanding what is the funder what have they built their portfolio on, and spending a lot of time understanding, their other companies, because if you understand your product market fit, you better see a lot in their portfolio mix that helps to kind of cross sell and feed into your product market fit. So the best, kind of funders in the world are also customers. And so, whether or not it's portfolio companies that they have who are great partners for you, who will buy your product, or who will be channel partners who will help resell your product, that's a great kind of metric for looking for a funder who's just like a really fantastic fit for you. So I would say, kind of in addition to having that, yes, relationship connection, the funders, and I think John or Bob, made the point, it's not just money. Like, you really want somebody who's going to help put your business model on steroids, put partners in your lap, put customers in your lap, because ideally, you really want to kind of sell your wares in order to earn your way, and not just kind of continue to raise, more and more money.
Great, thank you.
Anthony, can I just jump in?
Yeah,
I
please.
wanted to mention something about diligence and this finding the right funds and the number of deals a venture fund might see. We might get a couple thousand deals a year into the fund. That doesn't mean the partners are actually looking at those deals. And this goes to Shai's point about your $1 million deck. Typically, when a deal comes in, it's going to be seen by a pretty junior analyst, and there's going to be some pretty coarse screening filters that analyst is going to look at. Is it the right technology sector? Do you have certain milestones, and is it is it the right thing for the company at all? Really coarse screening. A lot of those deals are going to get filtered out really quickly if you don't have a good deck, if you're not meeting some basic things. And then to John's point about this 10-year deal, and we talked about that, and finding the right investors. You want investors that like you and get to know you. And when they make an investment, they say, you should go talk to my friend John or at Motley Fool, because I think he's really going to like you. And I'm going to call John and say, I'm going to send Shai over to talk to you because I think he's a really great guy. And we just did a deal, and you might want to be in the syndicate on this deal. So that's another way. If I can write you a $5 million check and John can write a $5 million check, all of a sudden you got 10 million. That's a really good story.
Just wanting to add to what Bob was sharing earlier too, when you're looking for, as an entrepreneur, what VCs to work with, what's that strategic value that VC can bring? Understanding, as Kirsten said, their portfolio companies. Personally, I'm a capitalist, so I'm hoping for a big exit. So I was looking for some big partnerships that we could partner with, hungry to expand it faster, or exit to. Luckily, we met Sands Capital. Sands Capital here in Roslyn. They were part of our A round and B round as well. They were big investors in DoorDash and Chipotle and Whole Foods. And so having them as an investor was a huge strategic value for us. They connected us to the founder of Whole Foods, Walter Robb. And after building a great relationship with him, he's now on our board and a huge advocate. So it goes a long way. And then I'd also say, having venture capital partners that are very supportive and nice. We want smart, strategic people, but also that are supportive. Starting and running a business is super hard. So getting the financial support is fantastic, but there's always a lot of tough decisions that have to be made at board meetings. And you really want investors that are super supportive of what you're doing, of your model, of your vision. That's super important. And that's something we found with Motley Fool. Motley has a different philosophy than I think a majority out there. And I think it's a model that's going to do really well for them in attracting deal flow as people understand, the value that they bring. And I've done exactly what Bob said. I have 5 startups that I've recently introed to Motley, because I'm like, these are the guys you want investing in you, and hopefully is a good fit based on what their portfolio is.
I'll add one other thing there, Shai, to your point, which that kind of common alignment of the goal, right? What is the ultimate sort of goal together, and to be on the same page, with what that looks like, but also in terms of, the kind of social impact part. So if you do have a model, if you do have a company that's also big on social impact, you can do, good while doing well. And knowing that you have an investor, we have interpreters in over 124 countries. We happen to be, in some cases, their main source of income, doing interpreting online for Jeenie when they don't have other opportunities to earn income right now, and they don't need a car and gas and car insurance in order to earn that. They just need their phone and a phone plan. But it's actually kind of become an interesting movement, and we've put a lot of people in a lot of countries to work. what that did in terms of attracting certain people who were interested in us when we started talking about some of those social impact goals was very interesting in surfacing a certain kind of investor also that came looking for us. So I think the more we talk about the things that matter to us, the more we talk about, how we think about our goals, what is success to us, if that resonates, with investors and that kind of, brings them to the surface, that's often a good way of finding your fit.
And Shai and Kirsten, in terms of when times aren't going as well, maybe you could just touch on how having the right investor, it's one thing when everything's going smoothly, but just from your own experiences, when times turn tough, how critical having the right investor on your side was.
Yeah, so real quickly, it happened, when COVID hit. We got on a board call and said, hey, our business just went to zero. I know it was fast growing and thank you for investing in our B round 2 weeks ago, but our revenue is now zero. And we were scared, we were freaked out. And, as I'm sure most people were when the world changed. And it was really assuring to hear our investors, specifically Motley, say, hey, we've got access to plenty of capital. You're well funded. If you need money, let us know. I mean, that went a long way to know that we were lucky enough that we had raised money so we could survive and that they were still going to be supportive of us not having to fire and furlough everybody. We've kept our staff. We haven't had to fire and furlough anybody. Thankfully, we haven't had to touch our Series B money yet because we've innovated on some new revenue streams, but that support came to us and allowed us to do what we're good at and innovate and figure out how to make money.
I'll use the COVID example just as Shai did because, this just all happened recently and, what could underscore the importance more of people kind of being behind you in those difficult moments other than what's just happened. And we were, we had just launched, we had Jeenie going for different industries. As I mentioned last year, we launched Jeenie for healthcare, at the end of January and, we were piloting in February and then COVID. So we had not even yet converted into kind of paying enterprise customers. And we were basically saying, hey guys, we're going to change our plan. We don't know what's going to happen with COVID. Instead of going after Series A, we're going to raise a little bit more now and try and kind of use that money to fuel growth. And, our investors looked at this and, here's a brand new market in the middle of a, national or international pandemic. And they, basically doubled down and they, a lot of them kind of stepped up for this round. We had some wonderful new investors come in this round as well, including our friends over at City Light Venture Capital. And they actually kind of got behind the vision and they're like, we see it, we get it. It's, it's healthcare in a time of, needed and increased healthcare activity. It's providing more equitable access to healthcare. I mean, we're part of a Harvard study now, and we were able to kind of talk about how showing that if you actually address the language barrier, you directly increase healthcare outcomes. And they're like, we can get behind what that means and basically put more into the company to help grow during a time where most people weren't even, able to kind of, survive. So it was critical to have those people share the vision, believe in what we could do. It's also, though, been critical that for those people who were already with us, that we had showed them already that we did what we said we would do, for them to believe that we were going to show up and do it again. So, I mean, you can't just sort of have, it's not just blind faith. Investors actually want to see that you're going to do what you're, going to accomplish. Yeah.
So we have a couple of minutes left, and I thought it would be great if everyone could just take a moment. We'll kind of go around and just share a final thought that you'd want to leave the audience with on today's topic, journey into venture capital. And maybe Bob, we'll start with you this time. And if we could everyone just share one final thought that you'd like to leave today's listeners with.
I wrote down a whole list of stuff, but I'll just say, this isn't easy. So raising money isn't easy. Raising money in a global pandemic isn't easy. You got to be prepared. You got to be organized. You got to put your best foot forward, and you got to focus on making your investors successful, and you'll be successful.
Great, thanks. John?
I did not have a whole list of things, so I wish I could look at Bob's list to pick up on. But I'm going to go back to my Elon Musk quote. I'm going to say, approach this business, assume you're wrong, and your goal is to be less wrong. And you want to work with your investors to figure out how to be less wrong.
Great, thank you. Shy?
Yeah, first is, just some hope for the entrepreneurs. Even though it's tough times, it's still exciting times on the tech front. You're living in a world of innovation. A lot of good ideas come out of these kind of troubles and downtimes. We're living in a world of AI and big data and self-driving cars and drones and, Bitcoin and, everything. It's so exciting. And then maybe another, food for thought is you don't always have to raise money at these tough times either. This could be a great time to just polish your product, keep perfecting it, keep getting that user feedback, figure out the marketing. It might not be the best time to raise money. And then, usually these things I hand out business cards at the end. So happy to share my email address, happy to advise entrepreneurs and encourage you guys. So feel free to email me at shy@tryhungry.com.
Great, thanks, Shy. Kirsten?
I also want to echo Shai's optimism. I think it's really important that, as entrepreneurs, we're encouraging, our fellow entrepreneurs to kind of, keep grinding. It's difficult right now, but there is, as Shai said, there's so much opportunity. And I think that what we're going to see is, kind of at the end, even of this year, going into next year, there are going to be so many doors flying open, for new ideas because people haven't been putting capital in a lot of places. People haven't been able to kind of, expand. They've been very focused on existing portfolio in some cases. So there's going to be a lot of kind of, interesting conversations to be had and opportunities. I think the one, sort of other piece of advice that I would share, and I hear this echoing in my fellow panelists to entrepreneurs is, you have to figure out what to be laser focused on today. If you look distracted, if you look unfocused, if you don't understand your market, who they are, where to find them, how to impress them and address their pain point, and if you're not clear on how you're measuring that progress, you're going nowhere. But at the same time, you've got to be that person that finds the balance between laser focus today and tomorrow and being entirely open to what your business ultimately becomes and what even the service becomes, because you don't know.
Great. So I'd like to really thank this incredible panel that we had tonight with Shai and Kirsten and John and Bob. And on behalf of the Next team, just to say how we love this DC Startup Week event and are always really excited to be a title sponsor again. And we think it's one of the really important and critical events during the year at bringing together the DC startup ecosystem. So I want to hand it back to Rachel and thank her for an incredible week so far. And we're looking forward to the rest of the week.
Thank you so much, Anthony, for moderating this very informative conversation. John, Bob, Kirsten, and Shai, thank you so much for your inputs and advice and enthusiasm for what the next step of entrepreneurship and investment looks like. So we're finishing up almost day 3. We have 2 more events coming at us. Right now at 6 p.m. we're moving into the Disability Startup Pitch Competition with Together International. So 6 companies are going to be pitching it out to win cash and in-kind prizes. So we're really excited for that. And then we're closing out tonight at 7 p.m. with a virtual garage networking party and a virtualness of a happy hour to kind of help people connect and network in a virtual setting. So it should be really fun. And then 2 full pack days tomorrow, Thursday and Friday. So I hope I see you guys either tonight on one of the upcoming sessions or tomorrow morning. Thank you, everyone, and have a wonderful afternoon. Evening. Oh my God, it's 6 o'clock. Bye, guys.